Hi and welcome to the Martin Bell Show. Hopefully you've been keeping well, and in today's video we're going to be talking about CFDs. So I actually haven't read through this article, so it's going to be like a blind read through, and then we'll have a look see some of the comments section. Some of them are good, some of them are pretty awful, but then again it is the comment section on newspapers, they're not always the best. So personally I do not own any CFDs, and I personally don't think I ever will, as I don't want to use margin to place my bets. It's basically a bet. So basically you don't actually own the underlying stock, you own the underlying price of the stock, I think, as far as I remember it as it is. And also you can use leverage. I'm thinking on one of the platforms that I was on before I moved to the platform I am now with, it was a 500 to 1 leverage, but they have reduced that. So basically, say if you put £1 in, you can leverage up to £500. So got my calculator here. So say if you put in, say, a £2,500 order in, you can leverage it 500 times. No, that's not right. That can't be 1.25 million. I hope that's not right. That is scary if that is true. They probably wouldn't allow the totally unaccredited investors to have that much leverage. Obviously, if you have more proof of your trades, you probably would be allowed to use more leverage. But it could go against you, and then you could get margin called, which is basically they sell your position. No, you have to put more money in, or they sell you out in your position, and that's when you can blow up and you have to declare bankruptcy. So it's very, very dangerous. And there have been, it's been a bit of a bull market at the moment with stocks going up, and there have been, sadly, people have taken their lives from understanding what a CFD is, and they lost this money, and sadly they've taken their life. So I think it should be regulated more, and I think it should be just for accredited investors only, and for people to know what they're doing. I think in the United States CFDs are banned, but in the UK and Europe they are not, as far as I understand. So let's start reading the news article and get straight into it. So while a host of... Hang on, let's go into the article. Here we go. Are you buying shares or high risk CFDs? I'm not buying CFDs, I am buying ETFs or shares. Warning, investors must tread carefully with free share trading platforms that also offer risky bets. And that's why I moved platforms, because the platform I was on, it was free to purchase and sell and hold my positions, and they also paid for my part of holding the ETF. So this couldn't be kept going up forever. I knew once they cut the CFD spread that they would eventually have to start charging to invest, and that was Trading 212 I moved from, by the way. And I'm not a licensed professional, this is not financial advice. Please do your own due diligence before making any investments. This is not financial advice. Please make sure you're fully aware before making any investment decisions, as your capital is always at risk for losses, and hopefully you do get gains, but as I said, there is potential for loss. So while a host of apps have brought the opportunity to buy and sell shares at no cost to the UK, some also offer the chance to bet on shares and other assets using high risky CFDs, contracts for difference, basically the derivatives. Derivatives that can let people go long, short and trade with borrowed money. Investors and people trading shares on a daily or weekly basis have been warned about this latter element. Platforms must carry a warning on CFDs about how many customers lose money when trading, and they often say that the number is greater than 70%. Personally, I like the peace of mind. If my stock goes to zero, I hope it doesn't, but if my stock goes to zero, I ain't going to lose any more than I put in. With a CFD, you could lose a whole lot more. It is really not worth it. So that I like the peace of mind and more conservative base, lean into a bit more growth but more income. But I am looking into this more. I may need to be more growth orientated, because I am slightly younger. I'm not the young investor, but I am younger, if that makes sense. As the society, people are on average are going to live longer than previous generations. Hopefully I do, touch wood. So we explain what you need to know to be tread carefully when we're looking for free share dealing. Roulette critics say some websites are offering free share dealing but also promoting financial projects unsuitable for long-term investors, and this is very true. Like Trading 212 offered free ISAs where you could buy, sell without a commission, and you didn't have to pay a fee for your brokerage, and you didn't have to pay for holding like an ETF as well. Let's say, for example, now I'm with Hargreaves Lansdown. I have to pay a £10 commission to buy, £10 to sell, and I have an account holding fee of 0.5% up to the sum value of £200 per annum of an account value, plus the fees of the ETFs. I know that sounds a crazy amount of money. I know, but nothing is free. You have to pay for it somehow. There is no way Trading 212 and other platforms, not just them, can keep this up. It's going to have to be paid for somehow, and once CFDs start to go down, or they're made illegal, it's going to have to be paid for somehow. And even Trading 212 have now started charging for deposits. I think it's 0.07%, but that's still not enough. At the moment, I don't have a large sum of money in my account portfolio, but when it starts to get large, I want to know it's going to be there in the future. And with Trading 212 and other platforms that are free, commission, as well, you just don't know what's around the corner. I'd rather pay my £10 and I know it's more secure, as well as ethically based as well. It allows people to take out CFDs and use massive leverage, not fully knowing what they're doing, and then they're paying for me to have a free platform to buy and sell shares. And ethically, I struggle with that as well, personally. So concerns are rising over the emergence of the new start online trading platforms that offer free share dealing, but also encourage stock market novices to invest in complex financial instruments. And I don't know much about CFDs and how it all works and how it is, but I just know it is very risky. And if you're very new in, you do not want to be taking risk. I know we've had a massive boom right at the moment, but there will be a pullback eventually when things start to recover on certain stocks, and others will perform better as well, and it'll all mix around. That's why I'm a long-term investor. Just buy and hold, buy and hold. I'm not a flipper, or they're called like a day trader. I'm not a day trader, not literally a day, but short periods of time basically, for an opportunist to make a quick buck. Nothing wrong with that though, if you want to do that, but it's more risky, and not many people do sustain keeping it up, being profitable, and it's a high level of stress. And I want peace of mind. I want to buy it, set it, forget it, and check on it every now and then. So critics say that the websites which offer free trading are promoting financial products unsuitable for long-term investing, taking advantage of the fact that hundreds of thousands of Britons are looking to better their misery returns on each cash deposits, because the interest rates are very low. And technically they're negative if the interest rate is 0.1%, and I think inflation, the last time I looked in the Bank of England, saying it is 0.8 or 0.9. So that means we're at a negative yield of 0.7%, but it's not officially negative 0.7%, if that makes sense. While a host of apps have brought the opportunity to buy and sell shares at no cost to the UK, some also offer the chance to bet on shares and other assets using CFDs, contracts for difference. Derivatives that can let people go long, which means you make money when the share price rises if you sell it. And also you can go short, which basically means if you bet on the price going down, and if the price goes down, you make money. But if the price goes up, you lose money. And if it goes up too much, you can something called a margin call if you don't put a stop loss on, which basically means you sell at this point. Basically, you get something called a margin call, as far as I'm aware, and they sell you out if you don't add additional fees, and this is when it can lead to major problems. and it can catch people out really badly. Some people have sadly actually taken the lives from this. So meanwhile, research has shown that as many 80% of Premier League football clubs have official sponsors that sell CFD and cryptocurrency. Personally, I'm not a fan of cryptocurrency, and I will be making another video on it why. And I would actually be really interested in hearing from the community why I'm wrong. But I'll tell you the reasons why I'm personally not a fan of crypto and Bitcoin. Well, I know Bitcoin and crypto are the same thing, but Bitcoin's like the top of the pyramid, like the known ones, and then the altcoins that they have, according to financial advice from Open Money. One expert says that the new platforms are no more than online gambling venues, while others are keen for regulator to step in so that novice investors do not end up losing money in highly speculative trades. Some have already raised their concerns with Financial Conduct Authority. One of the most popular websites is eToro. Yes, it's also attracted 500,000 new customers of all ages in the past year, and that is kind of scary. And you've got people not fully knowing what they're doing before they're buying these investments. You should know what it is and be able to explain to someone or yourself, or write it down in 5 minutes, or you should be able to in a couple of paragraphs why you own it and the risks against it. And there's also a rival who I was with these Trading 212. I'm very grateful that I discovered Trading 212 and they got me into investing, as I was into other forms of investing into other assets, but it got me into the stock market. But I was always like a Warren Buffett investor. I can't describe it. Long-term investor, no day trading or short-term trading. I was like value growth or more income based. Unlike the traditional wealth platforms providers like AJ Bell, who I'm with from ISA, and Hargreaves Lansdown, another great company. I do like Hargreaves Lansdown and I'm with them as well. That's who I moved to from Trading 212 to Hargreaves. They also let investors buy fractional shares, attractive to novice investors. That's what I have to say that is good about Trading 212. You can buy fractional shares, and it's not just because it's like a fraction because you're getting in new. It's also about the price, because Amazon shares are around $3,000 per share, and that is a whole lot of money to buy one share. But I think you can't buy fractional with AJ Bell and Hargreaves unless it's like a dividend payment, and then it can buy fractional. Otherwise you can't. I'm also thinking because you can't, I think there's a reason, I can't remember, it's quite complex. It's really hard to I think you're meant to buy whole shares. So say if I wanted half a share, on the flip side I think, say Trading 212 and eToro, who would buy fractional, they would buy the other half, or they would sell it to someone else who wants the other half, if that makes sense. The online marketing tools used to be used by eToro are sophisticated. If you type how to start investing into Google, one of the first results comes up is eToro. Go and do that now after watching this video. It's a platform, is easy to use, ideal for those who want to gamble on Bitcoin or other flavor of the month, such as electric car maker Tesla. Yet the array of complex investments it offers means that it's required to carry a disclaimer on its website. 71% of retail investors, which is you and me, which is not the professionals or the Wall Street or the Square Mile investors in London. It's you and me, retail investor, when trading on CFDs. CFDs are contracts for difference and differ remarkably from real shares. See box. Why CFDs are such a gamble? This is going to probably explain what they are. So CFDs that you trade on the likes of eToro are contracts for difference. These are financial instruments that allow you to place a bet on whether you think the asset will rise or fall in value. For example, if you price, for an example, this is not saying to buy this company, price of Microsoft is going to rise, you could buy a CFD that pays out if you are proven right. You lose money if the share price falls. The big difference is that you do not own the Microsoft shares. And that's the reason why I don't do CFDs, because I want to be an owner in that company and have dividends from that, or ownage in that company. The attraction is that the CFDs, you can use leverage, effectively debt, to increase the size of your bet. This means that if your prediction is correct, you make several times more money than you had bought the shares outright. However, your losses will also be greater, and in general most private investors lose money on CFDs. So you're taking more risk of huge downside with potential of not knowing the upside, which could be massive, but if the downside goes bad, you're in a lot of trouble. The platform also lacks the tools needed to build long-term wealth, so eToro doesn't offer investors a chance to buy funds or investment trusts, the fundamental building blocks of which most portfolios are built. This is another reason I'm looking into it more, and the reason why I moved to Hargreaves Lansdale. Though it does offer exchange traded funds. Basically, most of them are passive funds. Nor does it offer individual savings accounts or self-invested personal pensions. SIPs, the wrappers that keep investments free from tax. For traders who want to punt, know what they are doing, are not investing for the long term, which is not me. That is me, but I'm not the short-term investor. I am the long-term investor, which I am. That's another reason why I moved. For traders, these websites can be used for fun, but then again, you should only use money that you can afford to lose, and not rent money or any other form of money that is needed to pay bills to keep debt collectors away, or moral obligations to as well. But critics believe that they blur lines between what they do and what the traditional wealth platforms provide. For example, Trading 212 carries a table comparing its fees with traditional rivals such as Hargreaves Lansdale, suggesting they are of a similar ilk, and they're not. Trading 212 does not offer. It's hard to explain, but I think the main reason why people like Trading 212 is because it's free and they don't want to pay fees. I know you've got to keep your fees low to get good returns, but if you have hundreds of thousands, I know don't have hundreds of thousands, you may not as well. If you have a couple of thousand and you lose it if the company goes, you'll be quite upset. But imagine if you spent decades building that up and you have hundreds of thousands. It's better to sleep more peacefully and have it in a more established and safer. I think it's safer personally than these other platforms, because you don't know, they can't be free. Someone's got to pay the fee. The commission of buying and selling the share, that's got to be paid by someone, and also the fees for holding the ETFs, that's got to be paid for by someone else as well. The CFDs are currently paying for this, but it's got to be paid for somehow. Two traditional wealth platforms, an Interactive Investor and Free Trade, have written to the regulator claiming that some of the new trading platforms are misleading investors by drawing them in free share trading before pointing them towards risky financial instruments. Neither Interactive nor Free Trade sell CFDs. Alex Campbell at Free Trade says there has been an explosion in interest in share dealing, and there's lots of positive and negatives as a result. But we are concerned with platforms offer free share dealing as a loss leader to get customers through the door, then offer them risky financial products. Richard Wilson, Chief Executive of the Interactive Investors, says. I think Interactive Investors are good as well. It's fine to put a tenner on Tesla for a bit of fun, but you wouldn't bet your pension on it. He adds, it needs to be quite clear when you go onto a website whether you are entering a gambling venue or a wealth platform. Football giants are cashing in too. Worryingly, as many as 80% of Premier League football clubs have official sponsors that sell CFDs and crypto, according to new research for financial advice from Open Money. While the link between football and betting firms has come under scrutiny recently, risky online brokers have no restrictions on how to promote their services to fans. Clubs including Everton, Leicester and Crystal Palace have a partnership with eToro. Until lockdown, it was hosting free trading lessons at stadium. What? I didn't even know that. That is so bad. It's good that people are getting the information out there, but people should be very dubious. They're two very different sectors when you think about financials and wealth and people watching a football game. It's different minds. I don't know. I don't know. It doesn't sit well on me personally, but it's good that people are willing to do research to help better themselves. I do give them that. Leeds United has a partnership with FX, VC and Chelsea with Go Markets. Both are CFD brokers based in Cyprus. Up to 88% of FX VC customers and 44% go to market customers who invest in CFDs lose money. They reveal on their websites. Anthony Morrow, co-founder of Open Money, warns that CFDs are no different to gambling with your cash. He adds, as a financial advisor, we say these complex, sophisticated instruments have no place in people's financial plans. The fact these high-risk investments can be promoted to football fans through club sponsorship and advertisements during matches without any restrictions is wrong, and I do agree. People should fully know what they're getting themselves into, or they should be accredited investors only when they can prove they fully understand the risks and that they're not a danger to blowing up their wealth or going bankrupt, basically, when they're getting margin calls. So most people are unaware of the risky nature of these unregulated investments. I believe there should be tighter regulations to stop them causing serious financial harm. In reply, eToro says that 85% of its assets under administration are real and not CFDs globally. It says it restricts access to CFD trading by asking customers to complete an appropriate test first. I can always go and see what one of them tests is. I bet it's easy to pass, personally. It says those who don't pass can't buy them. We'll have to look at that maybe in another video. It's probably been... No, more. But the man on Sunday has found a way that customers can circumvent, or way around the test basically. eToro allows its customers to copy other investor on its platform, replicating their portfolios. So if you copy an investor who holds CFDs, you will be buying them also, whether you have passed the appropriate test or not. While eToro says it does not let investors copy the riskier portfolios, it admits some of them contain CFDs. It told the man on Sunday it's important people understand the risk while not here to catch anyone out. Holly Mackay, of investments website Boring Money, believes regulator of this breed on trading websites must be beefed up. She says they are regulated in the same way as traditional investment platforms. At some point, the regulator must acknowledge that there are a lot of people piling into high-risk investments that react to tougher regulations. These brokers are more likely to sell the dream of picking the next Amazon, whereas traditional platforms are more likely to preach a message of a diversified investment. The latter is less sexy, but also less likely to go pear-shaped. And yes, it also is because you have to delay gratification, and it's not going to happen overnight. That's why it's less sexy, and that's why people want to pick the next Tesla or the next Amazon They want the quick buck and they don't want to put in the effort. Mike Barrett, a director at a financial researcher at the Langcat, agrees. He says, you can dress up investments as sexy, cool, exciting, but for most people the best option is a middle-of-the-road, sensible investment strategy that they stick to. Trading 212, FXVC, and Go Markets did not respond to the request for comments. So my advice to you is, I shouldn't actually give advice, I can't. Personally, I do not own CFDs at all. I'm a long-term investor. This is what I'm doing. I'm not saying you do this. Please do your own research before you do. To have a diversified portfolio that has some income and some growth, for me, I'm going to look into a bit more growth, as I'm mainly looking at income at the moment, and I'm also looking into some bonds as well, looking into lots of different things, and actually some funds as well, actively managed funds and some passively managed funds, just a mixture, and it's not all in one area, if that makes sense. So we got the best rated comments first. They're not that great, I don't think, personally. So I think I agree with Dave here. Don't contact him at all. These high-risk gambles should only be available on these platforms for registered with professional status or accredited investors only. Personally, that's what I agree with. So hopefully you liked this video. If you want to see more of this sort of content, then please feel free to subscribe to this channel. Click the bell notification down below so you don't miss a video when I next release a video or go live. Smashing that like button helps me out, knowing you like the video, and it helps the algorithm as well. So thank you for watching. Hopefully you have a good evening, and I'll see you all soon.